wasn't on, so you guys are going to have to start.
It was on. It wasn't on there.
Okay.
Yep.
Gotcha.
So you guys want to take it from the top.
Sure.
Okay, well, good afternoon, everybody. I guess the mic wasn't on, so you couldn't hear us for the last 5 minutes. We've been exhausting ourselves with all kinds of incredible information that we've been disseminating.
We've entertained ourselves.
That's right. That's right. You missed all the jokes. We're going to start over again and start from the beginning. So basically what the purpose of this webinar is to really talk about the importance of a quality pre-approval when you're presenting your contract and some of the differences between what a pre-qualification or a pre-qualification letter may mean and what a pre-approval from a credible lender means and the power behind really that difference. And so we've got a deck up on the screen here for you that we're going to go through. But again, I think the big difference between a pre-qualification and a pre-approval is really that there is some validation of information. In other words, a pre-qualification oftentimes is a conversation that takes place between a customer, a potential customer, and a lender. There's some high-level information exchanged. No credit is pulled. And the lender says, yeah, based on what you're telling me, you should qualify for that potential mortgage, and in some cases they put that in a very simple, form letter that they send out to you. A pre-approval or a formal pre-approval would be where there is an underwriting decision rendered on the particular customer, whether it be via an automated system or actually an underwriter will pre-approve the file and there's credit pulled.
We have on your screen right now in front of you our names and our cell phone numbers so that you can text any of us or you can input questions to the right of your screen there. Text any questions you might have on this topic to any or all of the three of us, and we'll be glad to make sure that we answer those questions toward the end of the session. We have a series of slides here to go through talking about a pre-qualification versus a pre-approval. The most important thing is to know your lender. One lender to the next may have a slightly different understanding or policy or definition of what a pre-qualification is and what a pre-approval is. Some lenders, some originators, when they say a pre-qualification, that may include pulling and reviewing a credit report, discussing with the borrower his or her employment background, income, assets for the down payment, and so forth, and based on his or her experience and knowledge of the products, issue a pre-qualification. A pre-approval typically means obtaining documentation from the client, not just verbal information that, like Dan was referring to, and will or certainly should, again, know your lender, should include underwriting. At some lenders, possibly only by an automated underwriting system, which are recommendations to the lender, or with some lenders might also include an actual underwrite by an underwriter, with or without the automated underwriting.
In that point, sticking with the pre-approval versus the pre-qualification, gathering that documentation is so vitally important to us as lenders in support of you as agents, because as we are gathering those documents, as Dan had referred to, that's when you can uncover some possible hurdles or challenges that you know that you're going to face throughout that transaction, so that we can have dialogue with you as agents and work together as a team, in representing that buyer and finding out whether or not that you're going to be able to overcome those challenges. So it is very important to find out, again, how deeply committed that buyer has been to their pre-approval process, and have they provided the documentation, the proof to back up, what they're giving you verbally.
What you're seeing on your screen now are some of the general high-level points that are pertinent to a pre-approval versus a pre-qualification. And again, they can vary somewhat from lender to lender and what their policies are.
Just for those of you who may not know what a 1003 is, a 1003 is the residential loan application that's used for all types of residential mortgages, FHA, VA, and all conventional loans.
And all borrowers are completing that same uniform residential mortgage loan application for all of the different lenders. It is a uniform application that is gathering the same information that is going to be used for everyone in qualifying.
Then you have pay stubs, you have W-2s, 1099s, federal tax returns for the past 2 years. All of those are important to validate the information. Sometimes, for instance, just as an example, if you have a customer that may be commissioned or have some type of self-employment income and they have unreimbursed business expenses, and you're tight on ratios and you don't look at the Schedule E on the tax return, it could throw your debt-to-income ratio out of whack. So as the loan officer is interviewing the customer, they should be asking some of those types of questions based on, what the customer is sharing with them as far as the nature of their employment.
And then, of course, the asset documentation, the most recent couple of months' worth of bank statements, the most recent retirement account statement, if they're going to utilize any of those funds for down payment or for reserves. And, of course, if they have a property that they're selling, the listing agreement or the current contract on that property. Just a quick review of some of the documentation that the borrower or potential borrower should have ready and provide to their lender, preferably in advance of starting to look for a property, so that you know that they're pre-approved.
Absolutely. And one of the things that you can do to be proactive is letting them know, as Dan said, that these documents are going to be required, and and getting just a real quick kind of FYI on bank statements. Let them know if they've had any large deposits within those bank statements, in the past 30 to 60 days. They are going to be questioned by underwriting, and if they can't prove that that money was not borrowed money, you're going to have a problem. So large deposits are a huge red flag for underwriting if they are not payroll related and cannot be documented. So that's a good thing for you to know, to have these conversations with your buyers and being proactive and helping them to get approved.
And your loan originator, your lender, would like to know about these things earlier in the process as often as possible, just as much as you would.
Good point. Good point.
Also these days, borrowers feel sometimes like they're being questioned on just about everything. Explanations are a critical part now to every file, explaining recent inquiries on that credit report, going back 120 days prior to the date of that credit pull. And the lender is doing that just to ensure that they are considering all liabilities, all financial obligations that a borrower has now. And inquiries might indicate that there's a new debt now for a new car or a credit card or so forth that hasn't quite made the credit report yet. So that's why we question the inquiries and why borrowers are having to explain those. And, of course, the ever-popular explaining the deposits on the bank statements that Shelley talked about. If they have these scenarios, you can certainly prepare your borrowers as well to need to provide bankruptcy papers or divorce documents and explanations, not to pry, but again, just to make sure that we're considering all of their credit information and all of their financial obligations. In the ability to repay world that we're in, we have to make sure that we are fully analyzing the situation and documenting all debts that a borrower has and making sure that they have the ability to repay that loan. And ultimately, that means to be a successful homeowner, which is what we all want.
And ability to repay is a big thing that the federal government has now. That's a big term that we hear pretty much on a daily basis. And going back to one of the things that Dan had in the previous slide about leases, just because they have a lease agreement on a rental property that they may have and they're claiming, or they claim that they're claiming income on that lease agreement, tax returns are going to be collected as well. So you have to bear in mind, if they're showing any type of losses on that property, that's going to be taken into consideration too. So just because they say that they have a fully executed lease agreement, that doesn't mean that that can be used, to offset that current mortgage payment. So those can be a lot tougher to qualify when they own multiple properties.
Right, and there also has to be a history of renting that property. So a lot of people think that just because they're exiting a residence and they're going to turn it into a rental and they already have somebody lined up to rent it, that automatically that payment won't be counted against them, and that's not the case. So asking those key questions, getting them to a lender as early on in the process more so than anything else, it's going to save you time and energy in potentially showing them property that they don't qualify for, and wasting your time and kind of getting them excited about something they may not be able to afford.
Pre-approve your sellers. I tell my agents all the time, after you've listed that house, before you get too far down the road, pre-approve. Have your sellers contact your preferred lender right away to find out if there's some issues. You don't want to sell that house and find out that they may have credit issues or additional liens that the borrower may not, or the seller, pardon me, may not have been aware of, that are now going to affect their ability to purchase a new property. So you could have just now sold a house for them and left a family homeless because they can't qualify for a new home. Pre-approve your sellers.
And another thing to look for on the pre-approvals is they should certainly specify what loan product the borrower has been pre-approved for, what conditions of the pre-approval there are, documentation of this, that, and so forth, and should also include an expiration date, which is typically based on the date on that credit report and on documents that were provided. A lot of times the pre-approval may not specify a specific loan amount in order not to show their cards, if you will, when they're negotiating their purchase price, but certainly the lender that you have providing that pre-approval very quickly upon receipt of a contract can give you an actual approval with specific terms. Again, if you have questions, you can input them to the right of your screen. You can also text any of us. We're going to look now to see if we have some questions that have been input.
You have to drag it.
All right.
Mm-hmm. You have any questions popping up on text?
Not yet.
Okay.
Looked like you had. There you go.
Somehow she had dragged it at some point.
Is she? Can you go run and get her maybe?
Mm-hmm.
See if she.
We want to make sure that we're seeing your questions, any that you've input on the screen, and also if you have any, you can text Shelley or Dan. We listed the names alphabetically by last name. Dan and I probably should have been polite and put Shelley first.
Yeah, that's right. We should have been gentlemen and done that.
While we're checking to make sure that we're viewing any of the questions you may have input, we want to remind you that the monthly Learn and Earn webinars that are put on by your board committee, the Realtor Lender Committee, we love to get your feedback, your input, and that goes for also potential future topics for upcoming webinars. So please feel free to let any of us know.
Right.
Or let Amanda know here at the board office.
Okay, so we've got a question here. It says, the first one is, if you get a pre-approval from a lender, does that mean the borrower has gone through the first round of underwriting? I think, again, we tried to cover this, but let's go back over it again. If you get a pre-approval letter from a lender, and I think I'd mentioned this maybe even before the mic came on, but if you got disclaimer information on there and you have certain key information on the letter, most likely the loan has at least gone through the automated underwriting process and there's credit been pulled. That's really probably the most common pre-approval letter that is out there. Occasionally, you'll run it through the automated underwriting system and you won't get an approval. Pre-approval, but that doesn't necessarily mean the loan won't get approved or you won't get a pre-approval. There's just some variables in the particular customer situation that may trigger an underwriting, having to look at it. I just had a situation where a customer was relocating to another part of the country and was changing jobs. Even though the file was extremely solid, our automated underwriting system wanted me to refer to an underwriter for a decision because of the job change, less than a 2-year history on the job. So that's kind of one of the examples of why that might happen.
So in summary, to answer your question, that's really going to be a specific lender-based question. So you're going to need to pick up the phone and call that lender and ask that question. Has it been through an underwriter, or has it just been through an automated underwriting? Because, if you're not comfortable, or your seller is not comfortable, unless it's been viewed by an underwriter, then that needs to be discussed up front. So you need to actually speak to that lender, because with every bank, their policies are different. So a pre-approval may mean that it's just been through an automated underwriting tool, not necessarily a physical underwriter.
And the issue with the automated underwriting tool is, in most cases, the loan officer inputs information and the system decisions the loan based on the information that's input. Again, going back to one of the first slides, know your lender, know your lender's reputation and your relationship with that lender, because those systems and those automated underwriting systems can be manipulated. And so if there isn't validation of the information, you're entering in income, for instance, and there isn't a W-2 or a pay stub that's obtained, then you're basically just going on what the customer tells you without validating the information. So Shelley made a very, very good point. Calling the lender, having a conversation with them, and finding out what exactly was the basis for the pre-approval gives you just more information.
Absolutely. And then therefore creating a relationship moving forward. So if you know how that lender operates, especially if it's a new lender for you, you will know whether or not the strength of their pre-approval is actually something that you can move forward with and feel comfortable with. So pick up the phone. We're in a relationship-based business. That's probably the best advice that I can think of, to give you, is to make sure that you're actually speaking, to them about, what lengths they've gone to for that pre-approval.
We have two other questions. One is, can we send the slides out? The presentation will be posted on the CABR website, and you can look for it there. And if there's any question about finding them there, please reach out to anybody here at the CABR. There's also a question texted to me here, and I think we've touched on it, but just to make sure that we have, will you talk about the difference between a pre-qual and a pre-approval? It was texted to me, and since it was, I want to make sure, once again, we just touch on it quickly. The bottom line is there is a difference from lender to lender. Know the loan originator that you're working with, know the lender that you're working with, and like Shelley and Dan have both said, and now I'll echo it as well, get them on the phone, talk to them directly, and clarify what exactly that means. What information has been reviewed? Has it just been verbal? Has it been actual documentation? If it's a pre-qualification, did that include at least a review of the credit history in addition to what other information? If it's a pre-approval, was it automated? Was it a live underwriter? What is it? It's going to differ from lender to lender.
And your ultimate goal is, if you want to know that that's a solid deal, then that documentation needed to have been reviewed by an underwriter. That's ultimately, your utopia, so to speak. That means that the people that are rendering the decisions have seen the documentation, and if the buyer is going to be able to meet those conditions of the underwriter, then you know that you have a solid buyer.
I think two key things that you would ask if you call the lender, whether you're on the listing side or the buyer representation side, is has the customer actually made an application, filled out an application, and has there been a credit pull? To do a real pre-approval, you really can't do that without the application. And I think that was mentioned in the other slide here, one of the other slides. And then the credit information is really important, because not only will you see the credit score, but you'll see the obligations specifically listed and any derogatory information to include any collections. So that's really, really important, especially if there's a mortgage history involved. Making sure that the mortgage payments on their existing home have been paid in a timely fashion in the last 12 months is a very, very important decision maker. So,
okay, it looks like we have another question here. Is it wise to advise buyers to consult with more than one lender? Any questions up front a buyer can ask other than interest rates? Yeah, absolutely. Some buyers feel that, even though you may be referring them to your, preferred lender, that they would like to shop around, to know that they have more options. That is certainly, that's their right, and also to become an informed buyer. And also their personality. differences, as we all know, within our industry. They may not feel like they are working comfortably, with who they are referred to first off, and may want to talk to somebody else. So absolutely that can be the case. They just need to be cautious about how many times that their credit report is being pulled, so that it is not something excessive that is going to have a negative influence on their credit as a result. In interest rates, you guys may want to share too. In my opinion, we are all now pretty much on the same playing field in terms of interest rates, since the federal government has inserted themselves into our industry ever so lightly. Mm-hmm. They have really, again, created a level playing field. So you're not going to find that interest rates are going to vary greatly, from one lender to another. And remember too that the market is very volatile. So whatever interest rate we're quoting a buyer in the morning may be gone. It could be different in the afternoon, because the market does react to the stock market. So interest rates really don't seem to be as much of a factor in where the buyers are making their decisions anymore like it used to be.
Yeah, and I think to that point, as a successful real estate professional, you're going to want to have a couple of different lenders or contacts that you are familiar with, because your customers want that as an option, and I think you're supposed to refer them. If you're going to refer them, you're supposed to give them more than one option. But I think, know how your particular buyer profile might match up with the lender that you're connecting them with, especially first-time home buyers or people who may have challenges around qualifying. Really need to be working with someone who acts as a consultant for them and helps them through the process. A lot of times buyers are so focused on rate and trying to get the best deal that they don't realize that they really need someone who is going to spend the time to help navigate the process for them, advise them, provide them with the information that they need to make not only educated decisions about what product to choose, but really kind of help them document their file so that it actually gets approved, which is really the really important end result. Is it going to get approved? And to Shelley's point, Fannie Mae and Freddie Mac have really implemented a lot of changes over the last several years, and so quoting somebody rate over the phone before actually knowing what their score is or what adjusters they may be subject to based on their loan and their loan type. You could call 10 different people and get 10 different quotes, yep. And that's where the pre-qualification, pre-approval process is so important, because a good lender is going to ask some really, really important questions while they're on the phone with that customer that's going to impact the type of program that they may qualify for and what their rate adjustments may be subject to. So
other questions in addition or other than interest rate, because I would agree rates are pretty much what they are, very minimal variances from lender to lender typically. Other questions that they might ask would be, based on the information that I've given you, Mr. Lender, what program do you feel is best for me? And what is your experience with this program? And can you get me closed on time? My closing date is supposed to be X. Can you get me closed on time? Do you foresee any challenges there? Those are some of the other questions that they might ask their lender that are not necessarily rate related.
Good point. We have another question coming in. Again, feel free to text or put a question in the chat window. Have we gotten all of them?
I think we have.
Okay.
We try to keep these short and sweet and to the point and
yep.
informative, certainly, and your feedback is certainly welcome. The webinar will be posted on the website, the CABR website, the PowerPoint that we used today, and again, we hope that it's very beneficial. Thank you for attending.
Thank you. We apologize for the technical difficulties in the first couple of minutes, but I hope you made it through okay.
Please spread the word.
Thanks a lot, guys.
Thank you.
Bye.